The S&P 500 will suffer more pain as profit warnings and fears of rising interest rates threaten the key U.S. stock market indicator, according to the latest Markets Live Pulse survey. While earnings seasons have usually profitable for markets in the past decade, according to Deutsche Bank AG strategists, the upcoming one will hurt the stock markets, according to 55% of the 346 MLIV Pulse respondents. Optimism about a soft landing for the economy is fading as stubbornly high inflation keeps the Federal Reserve on a hard line. Bets for a higher for longer rates, along with terrible reports from FedEx Corporation to ExxonMobil and Nike, are weighing on the market sentiment after a strong rising of stock market in first half of the year. Negative noise from the earnings season will certainly be an element in helping slow the runaway train that is the U.S. market, especially if the economic indicator hints more rate hikes ahead, said Sophie Lund-Yates, lead equity analyst at Hargreaves Lansdown. The biggest negative effect of the earnings season will be the tightening of financial conditions, said 42% of respondents. Bets for a rate hike in July remains high after Friday's data. The decline in EPS for S&P 500 component companies will only stop after the third quarter, said 48% of respondents. Analysts also expect EPS for the benchmark's component companies to rebound in the fourth quarter of the year. JP Morgan Chase, Citigroup, and Wells Fargo will release their earnings reports in July 14th. About 53% of respondents expect these big banks to report disappointing earnings, which set to confirm a worsening outlook for the sector and hurt bank stocks. If companies fail to meet expectations for the third and fourth quarter in their outlook, then U.S. equities could be particularly vulnerable due to expanding equity valuations this year, said Peter Garnry, head of equity strategy at Saxo Bank AS. Tech stocks will be in particular focus as valuations have risen sharply after the Nasdaq 100 soared 39% in the first half of the year. While the hype around artificial intelligence has driven tech stocks higher, over 70% of respondents said the impact of AI on tech stock earnings has been overstated. That leaves companies leading the AI push, such as Nvidia Corporation and Microsoft Corporation, more vulnerable to stock declines if their earnings disappoint investors. Higher yields will put in particular pressure on long-duration assets such as tech stocks, said Ulrike Bahn, head of multi-asset strategy and research at Berenberg. We are more skeptical for third and fourth quarter U.S. earnings as consensus expectations are very optimistic. Amid the gloom, the biggest positives for stocks would be any signs of moderating inflation and cost cutting, a majority of respondents said. Overall, however, the outlook looks bleaker this time around compared to the surprisingly strong first quarter earnings. JP Morgan strategist Mislav Matejka said profit margins will come under pressure as companies lose the ability to keep raising prices as inflation cools and economic growth slows. There are likely to be winners and losers, but ultimately conditions are getting harder for everyone, said James Athey, investment director at Aberdeen in London.